Hello, welcome to Economics Matters. My name is Alex Kotlikoff. I'm glad to be back here on the podcast, and I'm joined, of course, with my father, Larry Kotlikoff. And today's guest is Scott Burns, a newspaper columnist at the Dallas News, who's been writing about folks and money for more than 40 plus years. Today, we're going to talk to him about sort of three case studies or three ideas that he's been writing about recently: making a plan to retire now, not later, whether a small house can mean a bigger life in retirement, and the couch potato approach, which he's going to talk more about: small fees and big results. So with that, I'll hand it off to Larry, who will give more of a description of Scott, and we'll proceed to talk about these three items.
So thanks, Alex. I'm delighted to have Scott on the program with us. Scott's a close friend. We've co-authored three books together: the the Coming Generational Storm, the Clash of Generations, and Spend Till the End. And I met Scott while I was giving a talk at the Dallas Federal Reserve, and somehow we ended up, I guess, on the same table or something. And we became kind of friendly, started talking, and then I had to go back and start working on this book, the Coming Generational Storm, and I realized that I could use a co-author, and I was somehow instinctively realized that Scott would be a terrific co-author on this. I don't know quite why, but I called him up and said, "Scott, I got to write this thing for MIT Press. I think it was MIT Press, and could you co-author with me?" And he said no, and I said, "Come on, I need you." It wasn't like I was looking for a ghostwriter or anything like that. Not at all. I just felt it would be more fun to write it with Scott. That was basically where I was coming from. And then so I waited a couple of weeks and I called him again. Would you do it? No. And then I think the third time he finally said, "Okay, we'll give it a try." So we became co-authors, and then some years later we wrote this other book, which was somewhat of a similar nature, talking about the long-run fiscal problems of the country. And then we decided to write a book on personal finance, the Spend Till the End. Anyway, so Scott, let me just tell you a bit about Scott, and then Scott will tell you a bit more about Scott, and then we'll get into these particular topics. And Scott's I guess, grew up in, I think, New Jersey, and then he went to decide he was going to become a rocket scientist, but then he got fascinated by the idea of growing things on rocket ships. So he went to MIT, got into MIT, became a biologist to help him figure out what he should be growing on rocket ships. So he was basically focused on being a rocket scientist. And then after a couple of years, he got intrigued by writing out of the blue, I guess. But he started writing partly to make a living in college or to feed himself. And then he's persuaded MIT to let him take some courses over at Harvard in writing. And he graduated and then had a career writing for the Boston Herald American, I guess was the name of what's called now the Boston Herald. And after a number of years, he went over to the Dallas News, I guess it was called the Dallas Morning News at the time, and has basically had a very long career with the Dallas News. And that continues because he tried to retire a couple of years ago, maybe a year and a half ago, and realized that retirement was not for him. And the Dallas News realized publishing a paper without Scott Burns was not for them. So that's a bit of a nutshell of Scott's background. Maybe you can fill it in, Scott, but let you take it away and then focus us on, we've got lots of crazy things going on in the market right now in the world of investing, but in the world of retirement, we've got a lot of people coming into retirement with insufficient resources. Many are highly dependent on Social Security. So take it away. Fill in what I said about your bio, but also move us on to your first issue, which is making a plan to retire now, not later.
Actually, the plan to retire now, not later, covers a lot of the issues. For instance, we're reminded every day by the financial services press that we haven't saved enough money. They would have us save more money day after day after day. They would have us saving from birth till death. We'd never spend a dime of principal, and it would keep them in their Mercedes payments. But let's start with this first case because it demonstrates that a person of limited resources can retire. They can retire early, and they can do it and have a better life if they pay attention to the levers that are available to them.
Hey, Scott, can I just interrupt you to say,
Sure.
maybe look a little bit more to your laptop, not to wherever you're looking.
Okay. All right. I'm sorry. Your picture's bigger on the monitor. I probably should have just had that. But
no, that's better. Yeah, now people can really see you. Otherwise, they're seeing yourself.
I have a good friend who his general circumstances are not good. He's 61. He's divorced, never had children. His mother and father have both died of cancer in the last 10 years. And a year ago, his only sibling died of cancer. To make matters worse, he has a job he hates where he has no possibilities of advancement, and but he still goes to work because he believes he has to, and he believes that he's got this idea that if he works till 67 and pays off his home mortgage and maximizes his federal pension as well as Social Security, that he'll be okay. And, he would tell me this, and, this is a good friend. He isn't nearly as sorry a soul as he sounds from this overall description. He actually looks a little bit like Hugh Grant and has the kind of diffident manner of Hugh Grant. But he still, the circumstances of his life are definitely not enviable. And I kept trying to say to him, you're talking about spending 6 years. You could be dead in 6 years. You could commit suicide in 6 years from the way you talk about your life. So I got so desperate. I said, I'm going to take you to Florida, and we're going to examine all the possibilities, because the only thing you've mentioned is that you've thought that you'd like to go to some place that's warmer than where you are, and you'd be happy working at a Trader Joe's. And there are Trader Joe's in Florida. So that's what we did. We took off for Florida, and we started looking. We actually found a home. It was a manufactured home in good condition in what's called a resident-owned community. That's an important distinction, because the residents cooperatively own the land, which means they can't be forced out, which is happening all over Florida. So you own that. As a result, instead of paying $1,200 a month to rent a little piece of land, you pay about $250 a month in the operating costs for that. That would shrink his shelter costs massively, and it would be enough that the limited equity he had in his house would pay for the entire purchase, and there'd be another $100,000 left over, which would be enough to pay the operating costs of that house. So there, in one move, he could essentially eliminate the biggest single piece in the cost of living for, people who aren't retired and retires. Shelter is a big, big deal. So we looked at that. Without going to Florida, we could have looked at other things and did. One, we looked at how much his pension was going to be, how much the benefit of deferring taking Social Security until he was older. He had one major benefit as a federal employee, which is what he was, is that he would have medical insurance from day one, even if he retired at age 62. The bottom line on it was that he had a choice. He could take a little risk and not work at all, or he could get that job at Trader Joe's and, do work that he thought he would like and leave work without taking any bit of work home with him or any angst from work home with him. And he would have a life. All he had to do was pack up his 12 guitars and go back and kind of start playing music again, maybe in some new venues.
How much was the earnings, were his earnings going to drop? And clearly
Uh,
his housing expenses were going to drop a lot, and he's getting into trapped equity, but
he was releasing the equity. His earnings were low to start with, around $60,000 a year. On the other hand, $60,000 a year is about the median income in the United States, so I thought that was a pretty interesting number to examine. And that shows another bias of the financial services industries. They're always talking about people who have high incomes. And, it's like ridiculous visits from CPAs coming to newspapers wanting to talk about all the variations you can do with stock options. Well, that just isn't even a newspaper readership, which is a pretty relatively affluent group. So anyway, he has that choice. And I think a lot of people have that choice if they are willing to take the steps to make sure, A, that they have health insurance, because that's a big, big bomb in taking retirement early. B, that they minimize shelter expenses. And C, make sure that you've extinguished all debt.
so, right. So, quick couple of comments. Maybe Alex is going to jump into, but I guess Trader Joe's has health insurance for their employees. I must, right?
They do. I'm not sure of how many hours you have to work. And in any case, in this particular instance, he didn't need employer provided health insurance. So he was
Oh, because he had the
totally
federal.
free to do whatever he wanted that could help him make a living. He's also a wonderful grammarian. So he could have gotten any number of jobs in public schools teaching people this lost language called English.
So the basic thing is people have options. Even if it seems like you're stuck, you have options. You have option, and and everything comes with some risk. I mean, if he sells his house and then he basically spends the trapped equity, then he won't have this kind of kitty of money that he could use to deal with old age nursing home costs, for example. So there's there's pluses and minuses to anything, but these are like safe alternative. Well, they're not safe. There's some risk associated with it, but there are options. But anyway, Alex, do you have any comments?
But you said that you by sort of joining this cooperatively owned community, and I'd like to hear a little bit more about how that actually works, particularly with regard to maintenance fees.
Okay.
Terms of yeah.
There are many of them in Florida. They are relatively hard to find in the rest of the country, but Florida was this, massive land of manufactured home parks for decades and well ahead of most of the rest of the country. And people banded together to buy their development. Largely because they were under pressure, because if the land got really valuable, the owner could say, well, I don't want to rent this to you anymore. Please take your mobile home and go. And there's a problem with that, which is that if most mobile home parks don't accept buildings that are more than 10 years old. So if you've lived in some place for some time, people could be caught. That's why this is entirely about, community-owned manufactured home parks.
So this is so you're talking about his getting a mobile home, living
Yes.
on it.
Yeah.
I should hasten to tell people here that Scott loves. Some people love antique cars of different types. Scott is a antique mobile home nut, to the point where that's maybe too strong a word, but he's got an antique mobile home in his backyard. Last time I visited you, you still have
I'm
that?
speaking from it. It's in the background. This we have two of them,
You have
and
two now. You went from one to two.
no, we've always had two. There were two abandoned, vandalized, ancient single wides from the 70s on this property when we
These are
bought it.
aluminum houses. It's all aluminum, right?
No, these are manufactured homes. One of them has an exterior that's aluminum. The other has an exterior that's been replaced with hardy board. they've both gone through extensive renovation, and the interior finish out standards are quite superior to what you'd find. We call one the Taj and the other is called the Mahal. I am speaking to you today from the Mahal and the library office of the
The
Mahal.
Mahal. So,
Yes.
yeah. Okay. So I think what you're getting a little bit of, listeners here, is that Scott is, he talks about money and people, and has been doing so for 40 years. And he's really a kind of a folksy guy in a way that no other personal finance columnist is in the country, as far as I can tell. He really meets people, and he kind of gets into their situation in a deep way, and then apparently tries to help them out in a very personal way when he can. So he's a sweet guy, a very caring person, but also very incredibly down to earth. And this is something that comes across in his columns. If you go to scottburns.com, right? That's your main
Yes.
website.
Yep.
So you're going to find advice about investment. That's the couch potato. So laying on your couch and being like a potato and doing nothing, but investing in a way that's going to basically hedge your risk and give you diversification, and has done well through time. So Scott has some very simple investment advice, and then he's going to talk to us about it. But also, all these columns are posted for going back years, so you can sit there and get advice and insight on basically any topic in personal finance, going back probably 40 years of writing for the.
Well, I have some copyright limitations, but I think going back to around 1995 is pretty good.
That's pretty good.
Covers more of imagined history than than most people care to think about.
That's quite good. Yeah. So let's Alex, let's hit him up.
Well, I
with
guess the question is what. So maybe we should move to the punchline here. Did your friend take you up on this option, or did he realize that this was a viable option?
Well, the answer is no, and it's a happy story. After years of being stymied and not getting raises, he finally, this is a very timid person, he finally got up the nerve to go in and ask for a raise. And the person he reported to said, "Oh, thank God you just want a raise. I was afraid you wanted to retire." So they were worried about losing him, and inside of 6 months, he got 2 raises. So he's going to stick it out. I'm still, and of course, it's kind of been beneficial that he decided to stick it out because the area we were looking at was just north of Sarasota, Florida. Thankfully, we never looked down at Fort Myers or whatever he had bought might have been floated away.
So this raises the kind of broader issue, which is that with inflation, we have some companies are keeping even with inflation in terms of the wages of the workers. Some employers are taking the advantage of saying, well, we're going to raise my prices, but not my salaries. I mean, I work for Boston University. We've had an 8% inflation. Across the board benefit salary increase, the basic salary increase is 3%. So the university's lowering everybody's wages by 5%, while at the same time, unless I've got this wrong, is advertising a bonus or an increase in salaries as if they're not reducing the salaries, and they are. So what I'm trying to say is that there are big reasons here to get actively involved in demanding your real wage be kept the same and not lowered, and the best leverage for that is to look around for alternative options. And once you have an alternative job offer, employers tend to respond and try and match it if they value your services. Anyway, Alex, go.
Well, I have a question. So I think I have actually a question for both of you right now. Given that inflation's around 8%, and for someone in their early 60s that's considering retiring, I think one of the bigger questions that we're asking here is, how do they bridge the gap to get to Social Security, to maximizing their Social Security, And even once they get there, my question is, what is Social Security doing right now to match inflation? Is it matching it appropriately?
That's a long question. Social Security is something that's it's kind of like beauty. It's in the eye of the beholder or in the pocket of the spender. The people who lobby for Social Security, they'll cite the CPI Index E for the elderly and say that this is the one that should be applied because it has more medical care in it as a percentage, and that's more relevant to older people. But again, it depends on which older people. Not everybody is totally infirm, and so it doesn't necessarily apply. So I think you just, when it comes to measuring inflation, you take a standard measure, whether it's CPI, W, U, or E, and you hope that that is somehow measuring the general level of inflation. We can go on, at great length about whether the component for housing is even remotely accurate, but
Yeah.
I'm not going to
So
solve that
yeah.
here. I think the point of view, Alex, to get to the meat of your question, the average retiree getting an 8.7% increase is going to do a lot better than the average worker for this year. We're talking, 8.7 versus maybe 5%, and probably less than that. So, I don't think retirees should complain too loudly in front of people who are still employed. The other side of that is, hey, things are looking pretty good. At the beginning of this year, you would get diddly squat on any savings that you had. We're talking 1% or less on any kind of insured investment. And now you can get 4% just about anywhere. So, retirees are going to be doing relatively well.
When you say 4%, you mean on long-term bond treasuries, or?
No, I'm talking two-year treasuries now. I don't look at those long bonds. They, retirees shouldn't. You're not going to live that long. The the yield curve actually peaks, I think, between 2 and 3 years.
Right. But of course, after inflation, if inflation continues, currently it's running around 7% retrospectively. If that continues, that would be negative 3% real.
It would be,
inflation,
yes,
yeah,
it would. I'm just talking about the change relative to workers.
yeah. But
There's been an almost infinite change in the income from savings for the first time in 20 years. I mean, we really need to we need new people looking. We've got a whole generation of recent adults, people between 20 and 40. They don't know what paying interest is. They've got
receiving interest, receiving interest.
Well, they don't know what's receiving is, but between 20 and 40, more people are paying interest than receiving interest. And so they've had the benefit for 20 years. And this is a gigantic generational shock, negative for people who are younger and kind of positive for people who are older, or at least relatively positive.
So let me make a couple comments, then we're going to move on to your second kind of case study you wanted to talk about today. But so on Alex's question about how does this guy make it between 62 and let's say 70, working at Trader Joe's would be the answer. I mean, he's trying to figure out how to fill in. And then, of course, if he had retirement money that he could tap into, he could do that because on a risk-adjusted basis, the return to the market is lower than the return to by a mile and the return to being patient with Social Security and taking a 76% higher benefit at 70 versus 62 adjusted for inflation. But then the other thing I wanted to say about Social Security's COLA, which is Scott's telling us properly that different people are facing different degrees of inflation, and that's true. So some are more or less being compensated by their cost of living adjustment. But in general, the cost of living adjustment is coming a year and 3 months after the inflation occurred. That's the way they actually do it. So we're always behind the eight ball. So if we're running an 8% inflation, I'll even forget the 3 months. But if you're lagged, if the country is running an 8% inflation from January 1st through the following January 1st, and your benefit is bumped up by 8% after 1 year, you've lost over the course of the year 4% real. So everybody who's on Social Security, regardless of how much prices for them are going up, if they're facing the average price increase for what they're buying, they've experienced about a 4% decline in their real income this year from Social Security. And in other words, we should be moving to monthly CPI COLAs because inflation's so high. It's one thing to have a low COLA an annual COLA when inflation is at a low level, but when it's running around 7-8% a year, we should be monthly indexing anyway. But on to the next issue. Alex, you want to pose that?
Well, I guess the question is it better to have a small house? Because I think in those intervening years between 60 and whenever you're going to retire, it might be 62, it might be 70, it might be even later than that. Is it better to downsize? It seems like a lot of the financial industry is telling us that. Do you agree with that?
I do, and have before the financial services industry got the idea. Buying houses is like, it's the same kind of sale. Buy as much as you can, and not, instead of even the language use downsizing makes it sound kind of negative. How about appropriate sizing? The most common reader problem that has been presented to me by email and scrolly written mail over the last 40 years is from a person who has retired and is living in a very large house. They might be widowed. They're still living in a 3,000 square foot house or a 2,500 square foot house. They're living in a house that is way beyond what they need. The consequence is that they are not keeping it in good repair. So it's accumulating liabilities and becoming less and less attractive to buyers. And they are sitting on a lot of income that could be used otherwise. Because the biggest benefit that all of us can have is to maximize what economists call imputed income. The income that we have from services that don't happen to involve the passage of money. The biggest one of those is owning your own home, because you're not paying a mortgage anymore. If you're 65, you may have some kind of tax break. I don't tell people the taxes that we pay on this property because it's almost shamefully low. That's because we have a wildlife exemption and 2 manufactured homes that people consider to be worthless after 5 or 10 years. So, and the consequence of that is that we have more discretionary income of the income sources that we have. We haven't got a whole bunch devoted to keeping a shelter over our heads. It's always been it. Now, the problem is that people, just as my friend that we discussed earlier, had his head stuck on needing to keep working till he was 67 and then retire when he had this, and this done, is that we got our heads caught on, oh, well, I can't sell my house because then I won't be me, or I'll have to give up the historic child rooms, where rooms are unchanged for decades and you can go in and remember when your kids were 3 years old against their will. And then you go ahead and die and you leave all that crap for the kids who don't want it. And by the way, they don't want your 30-year-old sofa, and they don't even want your sterling silver if you happen to have it, because they basically don't care. They don't want it. So here are all these people in their overly oversized mausoleums when they could be doing something to manage their life in a better way. Now, I'm kind of saying this in a I'm making it sound as though they're stupid, but we're all creatures of habit. And one of the best things we can do as economic entities is to try to break our habits of behavior, because we can change all kinds of things. We can change them all the time. We're human beings.
Well, let me add to what you said, Scott. And this was going to sound a bit like a commercial, but about 6 months ago, we spent a fair amount of time modifying Maxify Planner to expose how much people were spending on housing by not, what's called imputed rent. You refer to it. So if I have $1 million house, and let's say I could be earning, and let's leave out inflation. I'm not going to make it extreme. Let's suppose I could earn 10% on $1 million house, and I'm sitting there year after year. Well, a million times 10% is $100,000. So I'm paying, in effect, rent to myself. I'm renting this house to myself for $100,000 when I could be, and that's very, maybe I'm living on otherwise on spending $30,000 a year, but I'm spending $100,000 on housing because that's income I could otherwise be. If I sold my house, I'd have $100,000 of income each year, and that's basically the imputed rent. There's some extra factors, but to be able to see now in our lifetime budgeting, here's how much I'm spending. I got this maybe a $1 million house. I'm spending maybe over the next 30 years, 300,000 in present value on imputed rent, and the rest I'm leaving to my kids. The other 700,000 because I'm decided that this house I'm never going to sell. So if you move to a lower cost house, your imputed rent is going to go down, and of course, what you leave to your kids will also go down. So, but at least you get to see the price tag in front of you of what you're doing, because
Yes.
without seeing that in black and white, you don't know what you're spending. You don't know whether you're giving, and that imputed rent can be very high or very low depending on what the interest rates and the inflation rates are.
Larry, I know you live you live in Rhode Island now. It's still an expensive area, but not everyone lives in the expensive Northeast. But that's how my first lesson as a syndicated columnist came through. I had these letters repeatedly, and we're starting from the early 70s, people trying to decide to retire. What they did was what economists would call regional arbitrage. I had these letters from people who never had a high income, but they happened to have bought a house in the suburbs of Long Island in the 1950s. And the consequence was that house was worth maybe 10 times the income they were working, sometime earning as workers. So what they did was that they sold that house and bought a house for half as much in Florida. And that's what drew my attention to Florida for the first example. But there are other places that become destinations. Everybody in Michigan knows about the existence of a state called Arizona. In Dallas, the people looking at the population growth 20 years ago discovered that one of the major population growth segments was people 55 and over. And why was that happening? Because their adult children had gotten jobs in Dallas. So as grandparents do, they followed the grandchildren, and grandchildren are usually the issue of your children when they become adults. But and it paid them at that time. You could move easily. The late Carl Case, the Schiller Case home price indexes that we see every month. He once told me about that most of his graduates from Wellesley, where he taught, didn't stay in Massachusetts anymore. And this was years ago because they simply couldn't afford to. They would have to go somewhere else in order to buy the housing. So there's this regional arbitrage.
Yeah. So we moved from Boston from a Back Bay apartment to Providence, the price per square foot for comparable, quality housing was one third as high when we did this 2 years ago. So, absolutely, one has to understand what one's paying, and one has to look for different jobs, be on that market. One has to be on the housing market full time. I have a friend who's working in Bali remotely. He's got all kinds of people coming in to clean his house, give him a house, give him a massage, make his dinner. The rent is incredibly cheap. He's living in Bali and working in New York. He just has odd hours, and he doesn't have to be going to meetings by Zoom all the time. But anyway, Alex, let's hit up Scott with the last question, then we'll pull this to a close.
Well, I think the last question, and this is just very important question, is what is the couch potato approach in terms of at least in terms of investing? The market this year has been pretty wonky. I have a little bit of money in it, and haven't gotten the greatest returns. And I would say that that's probably because I've been taking too much of an active approach. What does it mean to be sitting on your couch doing nothing and getting something that's safe and at a good rate?
Well, it means you're basically behaving like America's best and most famous investor, Warren Buffett, whose favorite holding period is forever. So they can't be all bad. But let me just go back and tell you about how I got to this. I did not start as an index investor. When I started writing columns, the index investing barely existed. And I was writing in Boston, where I had access to the portfolio managers at every mutual fund operation in the city, and that's a lot of money managers. And one of the things I noticed was that these wonderful, very articulate, highly quantitative people would give great interviews, and they would sometimes have wonderful, immediately trailing returns. And I would think, wow, these guys are really brilliant. And then 3 years later, their brains were scooped out, and all of a sudden, all their above averageness disappeared to dismalness. And then Morningstar started producing, consumer available reports and some early software that helped you evaluate things. And I started looking at the statistics. And, what happened again and again is I found that there was one thing that was a constant factor in having a higher return, and that was lower expenses. And the best instrument for lowering investment expenses is index funds, because they capture the return of the class. And the longer you invest, the greater the probability that you will be a top investor, not an average investor, a top investor, because you dispensed with anything that involved an expense. So my mantra is, if you are capable of dividing by the number 2 with the aid of an electric calculator, you can manage your own money. And you take your money, you divide it in half, you put half of it in the total bond market index, you put the other half in the total US stock market index, and you'll do quite well. Well enough to retire, well enough to sustain a retirement, and you will avoid all the BS that is coming at us night and day from all the talking heads on television who are filling up time and space with garbage and putting meanings on things that aren't there, making guesses and talking about a future that they have no idea about, because they're like the rest of us. We can't predict the future. So, we could go on from there. I once bought all the apparatus of being diversified, and I expanded the couch potato portfolio holdings. I didn't recommend that people do it, but I said, if you're interested in being more diversified, this is the path you can take and do that. Fact is that over the last 20 years, the simple divide by 2 has done the best. And I think there's an explanation for that. I haven't haven't seen it examined, but it's been generally observed that diversification has done nothing for people over at least the last 10 years.
Well, wait, Scott, I mean, the index fund you're talking about, bond index and stock index, you're talking about two index funds at low cost. Those things are diversified across their different securities. So it's not like you're saying going beyond that to buy so much in gold and so much in Bitcoin and so much in commodities. That's not adding much, I
Right.
guess.
Well, no, the asset class universe, Bitcoin is only a recent addition, but the asset classes that people look at are international stocks, emerging market stocks, value stocks, growth stocks, small stocks versus large cap stocks. There's a whole thing that the financial services industry presents us with so that they can sound smart and make all these distinctions that make our brains hurt. And what's happened instead is that the financial markets, with the creation of exchange traded funds, they have homogenized the market. And one of the other things that isn't discussed very often is that if you invest in the U.S. market, about 43% of the earnings of the S&P 500, which account for 70 to 75% of all market cap in America, come from overseas. So you are diversified inside the total U.S. market on a global basis. I've got
So
a call.
buying like the Vanguard Total Stock Market Fund. I think it's VTSAX. I have no connection to Vanguard, by the way. You get, as you said, you get international investments through the back door by investing in U.S. companies or operating overseas. You get probably many of the companies, some of the REITs probably are listed, real estate investment trusts are more listed on the stock market, mining companies, commodity companies. So yeah, and if you go off and try and buy, let's say, gold mines on your own, in addition to this, you're probably paying extra expenses. So this goes back to your theme that keeping the expenses low by one-stop shopping or two-stop shopping. Uh, my concern with bonds that are not inflation indexed is inflation, and we've seen a huge decline in real values of the decline in the bond market because interest rates went up not due to real interest, the real productivity of capital in the economy, but because of inflation.
Yes.
And if you're stuck in a nominal bond, let's say a 30-year or 10-year bond, and the prices went up by 7%, 8%, you just lost 8% of that. It's never going to come back. So I'm a couch potato guy who likes inflation index bonds and the broad stock market, and you're more of a broad stock market and nominal bonds guy. Talk about that.
There's a difference there, and when inflation-linked bonds first came out, they were a fabulous buy. They were priced about, when there's low volume, they were about 300 basis points over the inflation index. And that blew away historical regular bond returns that were 1 to 200 basis points over the rate of inflation. But as people got accustomed and the market in inflation-linked bonds got larger, and as people got more and more cognizant of inflation, that premium got priced away, and it actually got to be a discount, so that you were getting slightly less than inflation. So and those bonds have been more volatile. So I like the idea of inflation index bonds. I think if I was allowed to make things complicated, what I would do is build a ladder of inflation index bonds so that the money would appear in real purchasing power in the year that I needed it. But if I get involved in the buying and selling of those bonds without a terminus date for when the actual money needed appears, I might get into some difficulty. But
So let me say that slightly differently because it's kind of a deeper insight, which is that if you buy a bond, you put out some money whether it's a nominal bond, if it's a nominal bond, a regular bond, you're going to get back some dollars, the coupon payments and the principal back. And so regardless of what happens to the world, as long as the company doesn't default or the government doesn't default, you're going to get this payment. And if you buy inflation index bonds, those coupon payments and the final payment will be adjusted for inflation. So you'll get back real income. And you can only really get burnt by if you sell the bonds halfway or at some point, and where the market might be for those bonds might be low. You could sell low price and then try and buy something which could also go down in value. But when a bond price goes down, because it's kind of tied down to what you're going to get, the payoff is in the future is tied down. If you just buy and hold, if the market price goes down, the yield goes up. So this stream of income doesn't really change, and the principal payment is, of course, the same. So that's different from stocks because there's something tying down the end, what's coming in the future. Whereas with stocks, you don't know what's coming in the future. There's no, for sure, you're going to get this much from your stocks. And that's a thing that I think economists haven't kind of conveyed to the public clearly, the difference between stocks and bonds. But anyway, I thought I would stick in a little bit of an economic lesson because that's what I do. Anyway, Alex, any final comments for Scott?
Well, I guess the question. Well, I think I want to say that I personally agree with the couch potato approach, and I think that even very smart individuals like my father can get suckered in by people who are interested in what's a hot stock. So we even tried that out over the last year, and simply we got burnt by that. I think
we did okay for a while.
We did okay for a while, but I think it's
That's what they all say.
Right. right. And I would have preferred to have just been in my index funds like I was before. So I think that even when things are looking good, you have to understand the downside when you're actively investing. And really the data shows that you can't really beat the market for the most part. That seems to be the lesson that a lot of people learn. So anyways, I just want to say that I agree with that approach, and that would be my final comment.
Alex, the thing is, we get to the conclusion you reached, but it can evaporate very quickly because we face this enormous pressure from all the people who assert that they have some knowledge of the future, that they have special information, that they are smarter than we are, that they, and on and on and on. And we have this ever-expanding media space that is filled with advertisements from financial services whose only reason to exist is making money off our money. So it's very, very difficult to maintain a couch potato mindset because you're working against, a world that doesn't want you to think that way. So I commend you for having a couch potato approach. I hope you have, are well girded, have nerves of steel, etc., and simply ignore all the people who say they have special knowledge, etc. Because we don't know nothing.
We don't know. The market's a random walk. It's where it's going to be tomorrow. There's a trend. The stock market's got a 9.5% average return. And if you just let the money in there and do its thing, it will, on average, as Scott said, with very high probability, do well the longer you have. But there's a lot of volatility, as we've seen this year. It's gone down 20%. It's coming back a bit. But the average typical year, the stock market can go down 20% up or down. So this 9% can turn into like negative 11, or it can be up to 29%. So so in addition to being kind of disciplined to let the money to not buy Wall Street's sales pitches and pay high fees for their what they're delivering, which is basically underperforming the market, we also have to be disciplined not to spend out of these assets that are risky because we're not sure they're going to be in the future. what they're going to be in the future. So if we're spending out of our couch potato portfolio through time, thinking that for sure it's going to do well, then we're taking more risk on. So I like to, and this is what our software Maxify Planner has embedded in terms of upside investing. I like people to be spending out of, what we're proposing is that people spend out of their safe assets, which I refer to as the TIPS portfolio, and then treat the stock market money as casino money and only spend it when it's been converted to TIPS, converted to safe assets. I think that's consistent with where Scott's coming from. But Scott, you have the final word, and I want to thank you so much. I think you're the folksy MIT rocket science who's become the folksy personal finance grandfather for the country. I think you were a grandfather when you were 25. In terms of,
Let me give you a story here, and it'll give you an idea of the deficiencies in the financial services industry. Many years ago, Peter Lynch, the investment wizard of Fidelity at the time and former manager of the Magellan Fund, wrote an article in Worth magazine in which he declared that you could have a 100% stocks portfolio and withdraw from it at a rate of 7% a year forever. He was assuming a 3% rate of inflation, etc. And I sat down with a stockbroker friend, and we used some software from the American Funds Group, and we tested how long your portfolio would survive using different mutual fund groups if you withdrew at a 7% rate. And the answer, in brief summary, was not very long. What Lynch had ignored is this whole thing that Larry just talked about, was that stocks can go up or down by 20% in any year. And statisticians call that variance sink. And that is of particular concern to retirees, because Alex, you have the benefit of being able to invest new money every year. And if it goes down, you have an opportunity to buy at a lower price. For the people in the room who have the white hair, if we have hair at all, we have a problem. We take money out of the account. If we take it out in a year where the stock market's gone down 30%, we've started a death spiral. And that's what Lynch didn't take into account. And in fact, it took the industry about 5 to 10 years after that before they started incorporating variance sink into their calculations and discussions of retirement. So you can't really trust the financial services industry either for honesty or actually for levels of knowledge. I mean, if a joker, if a newspaper columnist can, on his home computer or on a visit to a stockbroker, show that Peter Lynch is wrong, how much should you trust these jokers?
Yeah.
Not much.
Right. Well, Scott, thanks a million for joining us. You're a close friend, family friend, and I love catching up with you. And we'll have to figure out our fourth book.
Yeah,
Definitely.
Yeah. Okay. All right. Well, it was great to be on, and Alex, it was really wonderful to see you. I've seen your dad's face a lot, but yours is the one that has changed the most. It's always
true.
A thrill to see little boys become grown-ups. Great.
Well, it's good to see you too. Thanks for joining us.
All right.
Okay.
You all take care. Bye-bye.
Okay. Bye.